markets are confused, but why? More big new IPOs coming, and Chery and Chrysler finally tie the knot. At a splashy signing ceremony last Wednesday in Beijing, Chery Automobiles and Chrysler formally and finally hitched wagons in a deal that has America's auto industry in a tailspin. Chery President Yin Tongyue indicated that Chrysler will soon sell a Chery small car in the U.S. for only $7,000 US. Chrysler Chairman Tom Lasorda has neither confirmed nor commented on pricing, but has said that Chrysler will sell Chery-made cars in Latin America next year and North America starting in 2009. 9 out of 10 Chrysler vehicle sales are in North America, so the company, now owned by private equity firm Cerberus Capital, is eyeing exports of Chery autos under a Chrysler brand such as Dodge or Jeep to capture markets in Europe and Asia. In a related note, Fiat and Nanjing Auto may or may not be dissolving their troubled joint venture. Fiat denies a cash infusion claimed in the Chinese press. Nanjing Auto bought the British MG Rover company 2 years ago, but its Fiat partnership has faltered. Ford and GM are racing to meet the new Chinese competition, but neither will have vehicles ready until 2010. And remember, Chery is just one of many Chinese auto companies positioning for the United States market. Chinese markets are up slightly as the week begins, almost recovering the losses from the sharp sell-off last week. The Shanghai Composite closed July 9 at 3,883.216, gaining just under 3%, and the news is the same across all major indexes. Speculation is that last Wednesday's more than 5% drop of the Shanghai Composite, down to just above 3,600, was due to worry over the spate of big new IPO share issues expected soon and the delayed impact of the tripling of the stamp transaction tax. Many pundits believe that Chinese regulators may have successfully cooled the market, and point in particular to the big decline in turnover volume, which is running around 1/3 the level of the May peak, and new shareholding accounts are also down to about 1/3 previous levels. I believe last week's drop was probably due to 3 events that happened in the first part of the week. On July 2nd, the National Bureau of Statistics released a macro report that indicated overheating in industrial production and in disposable income figures for April and May. The disposable income figures are important since many analysts inside and outside China believe that excess cash and few investment options are feeding the Chinese bull market. Wednesday, the 3rd annual EU-China Financial Summit convened in Brussels, and the Chinese delegation specifically emphasized the need and determination to maintain a tight monetary policy. The summit was ignored by the American press, but revealed progress in Chinese-European cooperation in accounting and auditing standards and progress towards Chinese acceptance into the WTO's Government Procurement Agreement. The EU and China also reiterated their desire for further convergence in monetary policy that could spell trouble for the dollar in the long term. Also on July 4, a day before the stock price correction, the head of China's National Development and Reform Commission, Ma Kai, said in a speech before a session of the Chinese Political Consultative Conference Standing Committee that China has failed to contain the risks of rampant growth and the country was overheating. Ma's comment alone was probably enough to cause nervous investors to start selling. The Chinese People's Consultative Congress, or CPCC, is one of the top advisory boards to China's Congress and, more importantly, the State Council that runs China's day-to-day government. As it concluded its session July 7, it called for China to issue national treasury bonds to cover the growing debt of Chinese public universities and to focus on energy efficiency as a top national priority. Chinese regulators continue to encourage big state-owned firms to partially privatize and list on domestic exchanges. At a confab in Beijing over the weekend, Qi Bin, a director at the China Securities Regulatory Commission, said the agency will speed up the process for A-share IPOs and continue to push H-share firms in Hong Kong to list on the mainland. An acceleration of IPOs remains expected for this month and next and include PetroChina, mentioned in a previous episode, that could raise $6 billion US, China Construction Bank, China Mobile, both mentioned here before, and Xinhua Energy, China's biggest coal miner, planning a Shanghai IPO that could raise $6.3 billion US. Xinhua is already listed as a Hong Kong H-share. Another coal giant with IPO plans is Yangcheng Coal and Electricity Group of central Henan province, that is looking to raise up to $1.3 billion US with a dual Hong Kong and Shanghai listing later this year. But perhaps the most exciting opportunity is the announced IPO of a unit of China Aviation Industry Corp. 1, or AVIC 1, a giant conglomerate in China's fast-developing aviation industry. Citibank was chosen as advisor for an overseas IPO of Avic One's Commercial Aircraft Company Limited that will include the assets of Avic's Shanghai commercial jet manufacturing operations. Avic One is restructuring and may list other units. It now seems certain that 2007 will be the year of the Chinese IPO. A report last week from PricewaterhouseCoopers says that China is on pace to raise $52 billion from new share listings on its domestic exchanges this year, making it the world's leader. Competition will no doubt increase between Hong Kong, New York, London, and other exchanges to retain Chinese business. And interest in Chinese shares remains hot. For example, the Hong Kong IPO of Vinda International Holdings, China's leading toilet and sanitary paper manufacturer, was 114 times oversubscribed, the company reported last week. Finally, in the wake of all the reports about the slave labor camp uncovered at a brickworks in central China, exposed not by Western media, but by a local Chinese television station in Henan province, China's Congress passed last week a labor reform law that will require written contracts for all employees, restrictions on the use of temporary laborers, and allow collective bargaining by China's state-controlled unions. The new law takes effect January 1. I'll see you next time.